He's a dear friend, and I've been meeting him when he was at Stanford, and then certainly met him when he was at the UCLA. He has done his higher studies from Harvard, his PhD is from Harvard. He was at the Graduate School of Business at Stanford, and before he moved on to UCLA, and he's at the Anderson School. Really happy, very fortunate. He's a great researcher, very scholarly work that he does, that he agreed to come and speak to our audience today. We have been trying to get him for a long time. Somehow it didn't materialize at all. And today we are lucky he's just completing his paper, I think, and he's agreed to share this paper with us. With this brief introduction, I hand over the proceedings to Dr. Arvind, our chairman, the EGROW Foundation, and the chairman for this session. Dr. Virmani, please.
Thank you. I remember some paper. Of course, we are not in academics anymore, but you had a number of joint papers. I think it must be about 10 years ago. What were you working on?
Yeah, I come frequently to present some work, sometimes at the Imrana conference or at the Indian Statistical Institute. So maybe that's when you saw me present.
Yeah. Anyway, no, I remember reading because I was in Washington in 2009 to 13. So I remember reading. Anyway, okay, so let's, because you have a kind of original research you're presenting, so we should take all the time. Because then, as you suggested, if there are clarifications, if anybody wants to ask a quick question, they can, send it to me on chat. And of course, I'll also feel free to, if I feel that some clarification will help our listeners, I will just ask you. Charan, you can do the same.
Exactly. And I'm so happy Mr. Suman Berry has also joined.
Okay.
Professor Ashima Goel has also joined.
Oh, great. So if they have questions, please feel free to ask. Professor saying he doesn't mind any clarification while he goes along. So if you can just put it on the chat for me, then I will interrupt him at the convenient time. Okay, Professor Romain, please go ahead. I'm sorry, I'm not fully able to. I don't want to say your name, your last name wrong.
No worries at all. That's fine. Well, thank you both, Dr. Virmani and Charan, for this very kind introduction and for the invitation to speak to you today. I'm delighted to be here. I wish this could be in person, and I hope that there will be a chance to do that, when the pandemic ends. I should say this is new work that is joint with my PhD student Bruno Pellegrino, who will be joining the University of Maryland as an assistant professor of finance next year, and my longtime co-author Enrico Spolaure, with whom I've written something like 15 or 20 papers over the last, it's I'm almost embarrassed to say 25 years. And he and I, are continuing along a project that explores barriers to interactions between societies. And this particular paper is about barriers to the flow of finance. So it's a very specific kind of interaction between populations or between countries. And we are exploring the factors that impede the movement of capital across borders, which is a subject that has attracted a lot of attention, of course, from policymakers that seek to attract foreign direct investment or foreign portfolio investment to finance their growth needs. And it's the subject of a very vibrant political or policy debate, I should say, about whether it's a good thing to allow capital openness to inflows of capital, or whether it has some downsides and dark sides. And our paper explores one set of issues that have to do with misallocation in the way capital, is invested across the world. And one goal of our paper is to quantify the extent of this misallocation and to put a number on it. So I'm going to try to argue that the fact that there are barriers to the movement of capital across the world creates significant costs for many countries. And I hope I will have a chance to tell you which ones, and we'll get a chance to see who would stand to benefit the most from capital flow, from more openness to capital flows. I should say, please feel free to interrupt. I have the chat box open as well, so I will be happy to answer questions as they arise, or it's simply unmute yourself and interject. I will try to pause and not speak too fast so that people have an opportunity to do that, rather than having a one-directional speech. I think it's usually more entertaining for it to be interactive. Okay, let me get started. I can't seem to advance. Okay, here we go. So the real question we're asking is, how efficiently is capital allocated across countries? The motivation for doing this is when you look across the world, you see that rates of return to capital are quite different. So I have a long-standing links with India, and my sister lives in New Delhi, and I can see what the rate of return to owning assets in India is, and compare it to the rate of return that exists in the United States, where I reside, and it's significantly higher, even I think risk-adjusted, in India. It's been the case, especially in the last year, where the Bombay Stock Exchange has been doing so well. But there's no doubt that there are big differences in rates of return across countries, and also significant dispersions in the availability of capital across countries. So if you look at the dispersion of capital per employee across the world, there's tremendous variation, and I'll show you some of that from the data and from what we would see if there were no barriers to movements of capital. So it could reflect risk differences, of course, but because also these differences could also be a flag of capital misallocation. In other words, because there are barriers, then the differences in returns are not equalized across destinations. So what are we going to do? We're trying to do a comprehensive study of capital misallocation. So it's a rather ambitious project. We don't claim to cover everything. In particular, a lot of issues that have to do with risk and differences in risk across countries are brushed under the carpet. We don't really focus so much on risk. So it's more of a classical approach to the capital account, where there's an investment opportunity that yields a certain return. If capital is allowed to flow across borders, returns get equalized. If capital is not allowed to flow and there are barriers, then there is no equalization. If there's no equalization of returns, then you have misallocation. And the question becomes, how much misallocation do we see, and who is mostly affected by this misallocation? Who stands to gain the most from opening up to capital movements? So that last bullet point on this slide, if some factors act as barriers to cross-border capital movements, what is their welfare cost? That's really an important part of what we're doing in this paper. Okay, I'm having trouble with my windows here, so here we go. All right, so we proceed in four steps. I'm going to try to go very quickly over the first step, which for the simple reason that it's not a great strength of mine to go through theory. I'm mostly an empiricist when it comes to economics. I think our model is useful to later as an exercise where we will do counterfactuals. We will take the model seriously. Not everything we say hinges on taking the model seriously, but I think it helps fix ideas. So what I'll try to do is give you a flavor of the theory rather than go through the details. Then I'll describe a little bit the data that we will use. We're going to use data on foreign direct investment and foreign portfolio investment. That is stock data. We will look at the stock holdings of various countries in other countries, because that's what we're interested in. We're not going to look at the annual flows. And we're going to then use this data to examine what determines both FDI and FPI positions in a bilateral framework. We're going to explore various barriers that impede the flow of capital. There's actually now 4 of these barriers. In the version I'm going to present, I'm only going to have 3. It turns out the 4th one, which was policies having to do with capital controls, quantitatively, is not that important in impeding capital flows, which was a surprise to us, once you control for the other barriers. The 3 that we're going to explore are geographic barriers, institutional barriers, and cultural barriers. And I'll say a lot more, of course, on how we measure these things and how we operationalize these measures of distance between countries. And then at the end, and I think it's probably the most interesting part, and I hope I'll get to spend as much time, or the most time on that, we're going to use these estimates of how extensive the barriers are to do some welfare analysis. We're going to use the model, and we're going to predict what would happen to world GDP, to the dispersion of capital, to the returns to capital in various countries if the barriers were eliminated. And you can do this in various ways. You can eliminate the barriers one by one, or you can eliminate all of them at once. You can do all sorts of interesting counterfactual analyses of what would happen to FDI and FPI, or more generally, what would happen to capital allocation if these barriers were removed. You might also think about situations in which you don't fully remove the barriers, but you partly remove them, or you reduce them partially. And this is all something our model and our framework can accommodate. We try to look at the extreme, just out of intellectual interest, which perhaps is not attainable, but is, gives you a sense of what the magnitude of the misallocation exists. Okay, I see there are no questions, so let me just give you a preview of the results in case I don't have a chance to go through everything. So we're going to see that foreign direct investment and foreign portfolio investment are strongly correlated with all three of these measures of barriers, and the rough magnitudes of each of them are equal. And that comes as a surprise because most of the literature has focused on geographic distance as the basic gravity determinant of flows of capital. And what we add to the table is this notion that institutional and cultural distances also matter. And what's surprising is that quantitatively, each of them seems to be commensurate with the barriers that you see from geography. And that's a bit different from what you see when you study international trade, where geography really plays an overwhelming role. It's not that institutional and cultural distance don't also matter, but quantitatively there are smaller factors in the flow of goods across countries. And you might know immediately why, because there's obviously, when you're moving goods, the transportation part of the equation is really important, and so geography plays a primordial role. This doesn't exist to the same degree, of course, in the age of electronic money when it comes to transfers of capital. If I want to send money to India, it doesn't cost me a lot more than it does to send money to Arizona, the state next door, and so geography matters perhaps less comparatively compared to these other barriers. So we're going to show that even with only three barriers, sort of a parsimonious specification, we're going to explain a lot of the variation in FDI and FPI. We're going to also predict out of sample that countries invest significantly within themselves. So one feature of the world economy, as you all know, is significant home bias in capital ownership. So Americans own too much American capital compared to what would be the case in an open world. The U.S. economy is about 15% of the world economy. Then you would expect, if everything were perfectly open, typical investor in the United States to have 15% of its portfolio, of his or her portfolio, invested in the U.S. And in fact, you see much higher proportions than that. In our sample, around 55% of capital is owned on average in a given country by the residents of that country itself. It's probably more than that if you expand the definition of capital to include things like housing, etc. You probably see even more home bias, but nonetheless, there's a lot of home bias, and we're going to predict that from the model, which is good. We're also going to have a model that produces higher returns to capital in emerging markets. So it's a very traditional neoclassical result that you can date back to Lucas's observation about why capital does not flow from rich to poor countries. When you have barriers to the flow of capital, the returns are higher in places where capital is scarce, and that's indeed what we have as a feature of both the model and the data. And so if you remove capital misallocation that is induced by these various barriers, we find that world GDP would be higher by about 8%, and the dispersion of capital per employee measured by its standard deviation across the world would drop by 41%. So huge reductions in world inequality would result from the removal of these barriers. We also find that the dispersion of GDP per employee, or you could think about this as GDP per capita, would also drop by 28%. So it's not just that the removal of the barriers to flows of capital would increase efficiency. It also has pretty important redistributive effects, and it particularly benefits poor countries with elevated rates of return to capital that would experience a large inflow of capital as a result of the dismantling of the barriers to the flow of capital. Okay, so I'm sure you'll have lots of questions on what it means to dismantle the barriers, and we'll come back to that. You can't reduce geographic distance, and reforming institutions and changing people's cultures or cultural distance might be a tall order as well. So I hope you'll ask me questions on really what the counterfactual relates to, because I'm eager to talk about this. I don't want to go through the literature in terms of citing people, but I do want to give you a sense of what's out there. There's a big literature about gravity in the trade literature, looking at the effects of various bilateral characteristics on the intensity of trade. And more recently, since the 2000s, really, so much more recently than for gravity, which dates back to Tinbergen and in the 50s, the original gravity model. You might even say it dates back to Isaac Newton, if you'd like. But when it comes to being applied to economics, it dates back to the 60s. When it comes to finance, the implementation of this model is much more recent, and I guess is less than 20 years old. But there is already a literature on gravity in the out there. It tends to be focused mostly on geographic distance and the traditional gravity variables, which have to do with the size of the economy. So you'll invest more in large economies, you'll invest more in economies that are close geographically, et cetera. More, there's also a big literature on in barriers to foreign investment and home bias. And I guess the seminal paper there is Robert Lucas's paper in 1990, Why Doesn't Capital Flow from Rich Countries to Poor Countries, which came to be known as the Lucas paradox. In a world where some countries have a small amount of capital per worker relative to others, you should expect flows to go to places where capital is scarce and earns a higher return. But we don't tend to see that. In fact, in recent data, we might have even seen the opposite, and emerging markets be net exporters of capital. And so that's been a puzzle that people have talked about, and it has launched a big literature on trying to quantify, where this home bias comes from and what its effects are. There's also a very large literature in economics now on misallocation. I only cite one or two of the main citations here, but our paper relates to that because we're going to go an extra step. We're not only going to estimate what the quantitative magnitude of the barriers are, we're going to then use these quantitative magnitudes to back out how much misallocation occurs. And for that, of course, we need the model. And to our knowledge, it's the first paper that does that in a general equilibrium framework where we take into account the whole world as opposed to a given country. Okay, so I'm going to go relatively quickly over this. I just want to give you a sense of the model. It's a model of the whole world. We have N countries. There's a destination country and an origin country. Each country can be both an origin and destination. I was looking at the data for India. Last year, I think 2019, 2020, India had the record inflows of FDI. So that's where India would be destination I. It was about $75 billion, if I'm not wrong. India, of course, now I didn't find that number, and it's in our data, so I could, is also an originator of capital, and FDI outflows from India are starting to grow as well. So all of you are probably much better experts on this particular data point than I am, but at any rate, we're modeling every single link in the network of countries. We have in our sample 77 countries, I believe, which cover over 90% of world GDP. So we essentially have, in our data, pretty much everything. And we're going to have both a production side and a consumption side. There's going to be a return on capital that depends partly on the level of income and the level of capital in the country. There's a wage rate similarly that represents the marginal return to labor that is very standard. So far nothing very new. In every country, there's there's two periods. So there's a period in which you save and consume, and a period in which you consume the remainder. And then there's each investor in each country has a subjective appreciation of the returns that they might get from investing in a given plant. So I'll say a little bit more about that. They can invest in a plant that's located in their country, or they can invest in a plant that's located abroad. That's where we have a specification of what happens when you invest abroad. Each person in a country has, let's say, $1 to invest. So we do that so that it remains a model in which agents are atomistic. Nobody really influences prices individually, and they're going to therefore send their dollar abroad to invest in potentially in a foreign plant or in a domestic plant. And there's going to be an intermediary, which is sort of a fictitious agent in our model that represents a loss in the investment return that accrues to the investor. So you can think about this as a fee that an intermediary collects, or you can think about this as part of the return gets lost in the repatriation because perhaps of imperfect monitoring, or the risk, some risk characteristics that could be modeled. It's a bit of a black box, but it's analogous to what you have in the trade literature when it comes to what we call iceberg trade costs. You can think about it either as a tariff or simply part of the output that is sent from country I to country J gets lost on the way. Similarly, here, part of the return that you get from investing in another country gets lost on the way. Okay, so that's the way we model it, very much like in the trade literature. Now, this D is a vector, so it's a vector of distances. There's various distances. You can think about it simply as geographic distance, but you can also think about institutional distance. Perhaps there are differences in legal standards that imply that if legal standards, for example, for bankruptcy, et cetera, differ across countries, then that might introduce some transactions cost. And then you might think about it as cultural barriers as well. If the two, the investor and the plant in which there's an investment, have different norms and values or speak different languages. Similarly, that could introduce some frictions and could introduce some barriers to the flow of capital, from the origin to the destination. We think about D as being 0 for your own country. So if you're investing your dollar in your own country, by definition, the geographic distance is 0, the linguistic distance and the cultural distance is 0, and the institutions are the same. You might think about that as a simplification or normalization. Okay, so we end up with a solution which gives us the share of capital that a country invests in another country. So this is the share of capital from origin country J that gets invested in destination country I. And what's interesting about this is, of course, it depends on the returns, but it also depends very importantly on the distances. And the share, of course, as you would intuit, is lower when the distances are higher. You can this is in terms of shares, but if you translate that in terms of actual dollars owned abroad, so you aggregate over all of the agents, each of them have $1 to invest, and you take the aggregate over an economy, then naturally an additional dimension of gravity beyond distance will come into play, and that's the size of the country. So it's going to be typically the case that large countries will get to invest more dollars abroad, and similarly, large countries will tend to receive more dollars from abroad, which is a natural sort of gravity force. So you'll see a lot of FDI and FPI between large entities, the US and China, China and India, India and China, India and the US, et cetera, just by virtue of the fact that they're large. Now, if you don't observe these large flows, that must be due to something else, some other barrier, maybe a policy barrier, a geopolitical disagreement, whatever it is. Okay, but size in itself is a strong driver here, and that's something that people have documented in the data. It's not something we focus on a lot. For technical reasons, we're not going to actually look at the effect of size. It's all going to go in the fixed effects, that we have in our model, and we're only going to identify the effects of distance. But it is there in the in the background, and it's doing a lot of work. So importantly, in our model, we say that capital is going to be efficiently allocated if world GDP is maximized for a given level of world capital. So imagine a given level of world capital. This could be, we have two versions of the model. One where it's exogenous, you have just an endowment of capital, and one where there's, you can allow the world level of capital to vary. The main model that I just presented is the latter, where there's endogenous capital, there's a savings decision, etc. But anyway, the results don't really change very much in the calibration if you allow for capital to be endogenous or not. And that was a bit surprising to us, but it seems to be the case. This is not where most of the action is. Most of the action is in the barriers. So we have this proposition. We're going to, we show that in this simple model, capital, these three statements are basically equivalent. So they're if and only if statements. So the capital is efficiently allocated is equivalent to rates of return are equalized across countries, which is equivalent to all the barriers are zero, meaning asset markets are frictionless, and there's no impediment to the flow of capital across countries. I think I've said a lot about this already at the beginning by way of introduction, so let me not spend too much time on there, but it should be intuitive that if you have rates of return differentials and asset markets are frictionless, then capital will move to where the return is highest until the returns are equalized, and that's how you get these three statements to be equivalent. Okay, so I'm going to end here with the theory. Just I think I've told you what it delivers is two things really: a gravity model for capital ownership flows across countries. And another thing it delivers is a way to back out welfare from this. In other words, a way to calculate what GDP would be in the absence of the barriers, in the absence of these D terms, if we were to have, the barriers go away, basically. I should say something important here. We have this this term that represents the barriers, D, and it's multiplied by an elasticity or a semi-elasticity beta here. So when we mean zeroing out the barriers, we don't necessarily mean making geographic distance zero, which would be silly. We're not saying that, let's shrink the world to a point where there's no distance. What is more plausible is to say, let's imagine that we had a technology that allowed us to overcome the geographic barriers. In other words, it's beta that would become zero. Okay, so the elasticity of foreign direct investment or foreign portfolio investment with respect to geographic distance would become zero. So you might think about this as better communication networks, better way to overcome the barriers that come from distance, et cetera. And similarly, we're not arguing that, to get maximal world welfare, we need to eliminate cultural differences between countries, which would be perhaps even more silly than eliminating geographic differences. But we're saying maybe if we had technologies like translation technologies or ways to reduce the impact of cultural differences, then that's really the counterfactual we're talking about. So that's a clarification I do want to push, because people often ask us, what do you mean eliminate the barriers? And you can't eliminate those barriers, but you can reduce their effect on foreign direct investment, and that's I hope something that policymakers will think about. And notice also, we're not really talking about policy here. So this is something that we only added recently, trying to capture, the extent of capital controls across different countries. There's data sets that Menzi Chin has put together over the years that capture this. And we do see, in fact, that, of course, countries with capital controls receive, pairs that have extensive capital controls between them exchange less capital, which is as you would expect. But it quantitatively doesn't play as big a role as some of these other, perhaps more fundamental barriers that we discussed. So I see in the chat, Charan is asking whether, what is the impact on world interest rates? So I think I don't know the impact in the model on the level of interest rates, but the dispersion goes to zero in the model, and I'll show you a little bit later if I have time. I hope I will sort of what are the differences that are implied by the model under existing under existing barriers, and how those compare to actual differences in returns that other scholars, not us, have put together, and they line up really well. We do a really good job at predicting return differentials just with the model. But the model does predict once you remove the barriers, these return differentials go to zero. I assume, because I'm tempted to say that because capital becomes perhaps more plentiful, I'm not actually sure what the impact on world interest rates would become, because that depends on what the endogenous response of the capital stock will be. My intuition tells me it will rise, and therefore the return will diminish, but I'm not sure. And of course, it depends on what happens to labor and many other things as well. But the dispersion for sure would fall. Okay, so let me get into the data part, which I think is perhaps more maybe more interesting. There's a big challenge. I was looking, in fact, at the Indian data this morning. If you look at the top origins for foreign direct investment in India, the list includes Singapore, Mauritius, the Cayman Islands, and obviously these are not the ultimate origins of the capital that gets invested. These are just conduits, where FDI gets routed through shell companies. And in our data, we have corrected for this. So we trace back we trace back to a nationality basis. That's not our doing. There's a data set that just came out last year by Damgaard, Erjaer, and Johansson that restates FDI data to account for these offshore vehicles. And when it comes to portfolio investment, even more recently than that, Coppola, Maggiore, and co-authors have constructed matrices that allow you to reallocate foreign portfolio investment to the origin country. So if you're buying stock, if I'm sitting in the US buying stock on the Bombay Stock Exchange, and I route this purchase through a broker somewhere in Dubai or whatever, that's going to be traced back to me, the ultimate owner in the US. So so that's also a way to restate the flows to really get at the true owner. I think you would get a very misleading picture if you didn't do this correction. Okay, so if you then compare FDI to FPI, this is the image you get. So they're very strongly correlated. The correlation is 63%. Obviously, these are two very different beasts. Foreign portfolio investment has to do with securities purchased across borders. Foreign direct investment is not like that. You directly invest in a plant. But nonetheless, there's a strong correlation between the two, because countries that tend to be open to one are also open to the other. We're going to examine three dependent variables, foreign direct investment and foreign portfolio investment separately, and then the sum of the two, which we call foreign total investment. And most of what I'm going to talk about is about foreign total investment, which is the holding of capital by foreign agents. Okay. The explanatory variables we're going to explore are geographic distance, which is mostly measured by geodesic distance, although we have other measures as well of geographic distance that have to do more with micro features, like whether you are separated by an ocean or a mountain chain, things like that. But we're going to focus mostly on geodesic distance. We're going to talk about cultural distance as well. This is work that my co-author and I have done over the years, using data from the World Values Survey, where people around the world are asked about their values on cultural questions. For example, belief in God, religious values, beliefs about how to raise children, beliefs about trust in others. A series of questions. We use about 100, and we aggregate them. We look at the difference between two countries in these answers of an average respondent, and we create a metric of distance in value space. And so that's what we call cultural distance. And we're going to look finally at there are questions I see in the chat.
Yeah, I was wondering, do you recall the distance between India and the USA on the cultural distance from your work, roughly?
I don't. It would be easy to find out. Not off the top of my head. I can give you a few pointers on that. I'm getting an echo, Arvind. Maybe It comes from, yeah, thank you. I think that's, there are some patterns that have to do with linguistic distance. So typically there's a very strong correlation between linguistic distance and cultural distance. And you can understand why, but typically countries that speak the same language or in similar language families, even controlling for geographic distance, tend to be closer in cultural space. Another feature of cultural distance, and that's from separate work that I've done with a different set of co-authors, is that India is extremely culturally diverse within itself when it comes to World Values Survey answers. It's one of the most diverse countries in the world when it comes to that. So maybe averages mask this diversity to some degree. I've done a lot of work on this particular bullet point, so I could speak for hours. Let me not speak for hours, but it's certainly an interesting question. Okay, I see lots of questions in the chat. I'll just, should I address them, Charan? Should I take them on board now, or do you want to wait a little bit?
Yeah, I think we are already at 9:40, so I think unless there's something really striking, I would.
Yeah. Okay, and I'm happy to answer them by email afterwards. And then finally, we have a measure of institutional distance, which represents arrangements that have been entered between the two countries in a pair about things like taxation, legal standards, common currency, and we create an index that represents how closely aligned countries are along those dimensions. Okay, so what do we find? Well, we therefore look at this gravity model, and here are some of the results that we find from this regression. Let me point you to the to total investment, which is foreign total investment (FTI) here. What you see, and these measures are all comparable to each other. So you can see these are just simple least squares regressions. That all three of our measures of distance bear negative coefficients, meaning they are barriers to the flow of capital. And we have a large number of observations. The data covers the decade from about 1990 to 2010 or so, and so about 20 years. And so it's a panel, and we find that these barriers are important. Importantly, it's enough to have these three to explain about 77% of the variation in FDI and FPI. I would say this is once you control for origin and destination fixed effects that capture everything that is fixed about both a destination and an origin that's been taken out. So here we really are explaining the residual from that. The part that is bilateral, the part that varies at the pair level, is really what we are capturing. And things are very stable across the various specifications. Using either an extensive set of control variables or not, whether we consider direct investment or portfolio investment separately, you tend to see similar relative magnitudes, and things seem fairly robust to these choices. Now, you might say a lot of these barriers might respond to increased economic exchange, so that you might be concerned about reverse causality. So we have a method to identify the effect using instrumental variables. Let me not go through the details of that. Basically, we rely on historical variables that were determined, previously. So variables that have to do with colonial status, the length of the diplomatic relationship, their distance in religious space and in linguistic space as well, to instrument for both cultural and institutional distance. And what we find when we do that is larger effects of all three variables. So the relative magnitudes are about the same, but the effects are larger. So we actually don't use these estimates in our counterfactuals because we want to be conservative and basically use the lowest possible barrier estimates that we come up with. So you can see here, they're roughly doubled. The magnitudes are roughly doubled when you use instrumental variables, but that's not that's not something that we end up exploiting. We would have been more worried had the effect been the opposite. That is, if we had seen attenuation, because then it would have suggested that our underlying numbers were sensitive to this reverse causality to a greater degree. At any rate, we don't use that. So we for the counterfactual analysis, we limit ourselves mostly for computational reasons to 2017, the last year for which we have data on everything. We're going to use data on purchasing power parity GDP from the IMF. We're going to use employment data, labor share data from the International Labour Organization. These are the things we need to plug into our model to back out the welfare effects. I think I mentioned 77 countries. I apologize, it was 72 countries, but it is true that they cover 93% of world GDP. So that's basically the data that we use for our calibration. So this is the first thing. So one thing you can do is with this data, you can calculate capital per employee from the model, because you take everything that the model has and you predict capital per employee. And what this graph shows is it compares what we get from our model to what you get from observing capital per employee directly. And what you see is a very strong correlation between the two, 92%. So the model does a good job at capturing differences in capital intensity across the world. It does a remarkably good job, I would say, at capturing that. We're really closely aligned around the 45-degree line. And remember, we don't use data on capital to back that out in the model. It's all based on data on foreign investment, supplemented with data on per capita GDP, etc. All right, so we do a good job there. Returns to capital, we also do a pretty good job. So there's 2 points I want to make with this. Is first, there's broad variation in the returns to capital across countries in the world, and so that variation is it's not like returns are equalized. Okay, there's a lot of variation. What's also quite nice is when you try to compute the return to capital in the model and to compare it to the return to capital that you observe in the world from a paper by David and his co-authors that came out as a working paper in 2014, you see that it lines up pretty well. So the fit is not as good as with capital per employee, but still we get a correlation of about 45%, and we do a pretty good job. A lot of the points are around the regression line, so we do a pretty good job at predicting this. In case you're interested, India's here. It's a little bit above the regression line, so India has actually a higher return than our model predicts in the data, but not by a huge amount, and that's what we have. You can also look at returns to capital and income, and you will see that the return to capital that is obtained from our model correlates negatively with income per capita across the world, and that's the stylized fact I was mentioning earlier in the discussion. That's a strong fact that I think we take a stance on. There's a debate in economics on this, but we fall squarely on the side of poor countries have higher returns, and therefore the return differential must be explained by some form of barriers. So this is a matrix that shows you for G20 countries, whereas there's actually 19 countries because we don't have data on Saudi Arabia, and we've created an artificial 20th country that's the rest of the world. So the G20 countries, we have their investment holdings across the world. Now, one thing that's very interesting is you can see that the United States as a destination country, so read across the row, has a lot of darkly shaded numbers, and that's people call the U.S. the supermarket for capital for the world. So a lot of countries invest in the U.S. simply because of the size of the economy, its stability, etc. Another point that I want to point out is the diagonal has very high entries, and this is not from data, this is from the model. So this is the model predicted ownership of own capital. So the model predicts that the United States should own 92% of its capital stock. Okay, and the model also predicts the United States should own 69% of Canada's capital stock, because that's how you would read this. Okay. Let me move on past that and give you the counterfactual analysis, and then I guess we only have 10 minutes left, so maybe there'll be time to answer some questions. So this is the counterfactual analysis, where we have basically 3 barriers: cultural, institutional, and geographic. We remove them, and then we use the model to predict what would happen to world GDP, what would happen to the standard deviation of capital per worker, and what would happen to the standard deviation of per capita income. Okay, so let's focus, for example, on over here. So our model predicts a world GDP that is has $112 trillion of world GDP. If you removed the barriers, our model predicts a world GDP of $122 trillion. The difference between the two is about 8%. Okay, so that's the bottom line, sort of misallocation cost of barriers to capital movements. And then you can see what would happen if you removed only one of the three barriers. Okay, so world GDP would rise by about $7 trillion if you only remove cultural distance, $8 trillion if you removed only institutional distance, and again $8 trillion if you removed only geographic distance. So that gives you a sense of the relative magnitude of the three. Of course, they're all correlated with each other. So if you remove all three, you don't get quite the sum of all three. But it gives you a sense of the relative magnitudes. Then these things don't depend very much on whether you allow the capital stock to be endogenous or exogenous. So you can compare the numbers from the top panel to the bottom panel. You'll see relatively similar numbers and relatively similar magnitudes. What I do want to call your attention to is the tremendous reduction in the standard deviation of both capital per worker and income per worker when you remove the barriers. So you see this tremendous difference. When you have barriers, the standard deviation is 69% higher than when you don't. Maybe it's better to show this graphically, and I will in a couple of slides, and I'll conclude with that. So if you look at capital reallocation, what would happen under the baseline model? The log capital per employee would rise tremendously. So you would, for example, Zimbabwe, let's look at this point here, would add 3.5 log points to its capital per employee if the barriers were all removed. And so the gains, and one thing I want you to take out from that, in contrast, the US, would probably lose. Why would the US lose? Well, because the US has such a strong home bias. If you remove the barriers, the US would send a lot of capital abroad, would end up with less capital. Capital per employee would fall in the US. Okay, so the winners from capital openness tend to be the poor countries with high notional returns to capital. And the losers tend to be the very highly, countries very highly endowed in capital. So, I mean, I guess one bottom line from this is if you want to impoverish the United States, open up your capital markets. But that might be just a caricature. Here's a graphical representation of the fall in dispersion. So the blue area represents the observed dispersion of capital per employee around the world, and the dotted line represents what it would be if the barriers were removed. So that's the 69% difference in the standard deviation is what is this dramatic reduction in the inequality that you would observe. So someone's asking in the chat, does India lose? Is India losing here? I have trouble finding the data point.
It's just below zero, yeah.
Oh, it's just below zero. Yeah, I mean, China, Brazil, very large countries. It might have something to do with size. So that's a good point. I'd have to look. It's not, I'm not sure how much weight to place on the specific guy. I'm placing a lot of weight on the slope, more than the individual points. I just, the distributive effects, go mostly to poor countries, in our model at least. Okay, so I'm not sure. Yeah, I'm a little bit embarrassed by this data point now, but but that's what the model implies. Okay. So also I should say this is the baseline model, but we have various variations on that. So I would have to look at how robust that is to the variations that we have for any given specific country. So all of them have had this feature of the downward sloping relationship. And one last thing, this is not losing in terms of GDP. This is the change in capital per employee, right? So this is not looking at what happens to GDP per person. It's capital per person. Okay. It might be the same. It might be different. Okay, so we also have the reduction in the dispersion of capital per employee is much more pronounced than the reduction in the dispersion of GDP per employee. But we also see a reduction in the dispersion of GDP per employee. And you can see this white area here, where the dotted curve is shifted to the right compared to the blue curve, represents the welfare gains that you see on average. So the average moves out to the right. Okay. All right, so just to conclude, we have a new model of international investment. It delivers a structural gravity equation that we then estimate using data that has been restated on FDI and FPI, so on a nationality basis. Then we show that culture and institutions are as important as geography in shaping bilateral investment flows. And we find once we use these barrier measures and we plug them into the model to back out welfare differences, we find important gains from reallocating capital, about 8% of world GDP, and highly heterogeneous effects across countries with significant implications for inequality. And in particular, we see that the countries that tend to benefit the most from this reallocation would be the poorest countries. So thank you very much for having me. We still have about 4 minutes. I'm happy to take questions. Maybe Arvind, you can.
Yeah, before I ask Professor Ashima Goyal she has a question. But before that, I think there's a lot of interest in the details of your variables. They are new to me also, probably because I haven't been looking. But do you have a kind of in your paper? Are they all there, kind of, for people to see?
Yeah, they're better defined. So I see that there's a question whether it's equity or debt. The portfolio investment includes both. So it's the most comprehensive measure of portfolio investment that we have. So that's what I will say. Now, as for, I think there's all sorts of issues with aid that I do not think are captured in our data. So aid flows are not there. That might be an issue. We think that our paper applies best to market determined flows rather than flows that are determined on other, based on other considerations. Also, the measurement might be tricky there. So it's whatever is reported by the OECD and the IMF is what we capture in the foreign portfolio investment, but it does include both equity and debt. And for now we haven't differentiated between the two. I've shown you the correlation between FDI and FPI. They're very highly correlated. I wouldn't be surprised if something similar held for the debt and equity component of the portfolio piece.
I was asking about the, your distance variables, which are kind of interesting. Institutional, cultural, those variables, you have them all, I presume, in your paper or somewhere else, or where could
yeah,
we?
So the data that we use here comes from a paper that Enrico Spolare and I wrote called Ancestry, Language, and Culture, in which we looked at the relationship between linguistic distance and cultural distance measured in this way. And we have a much more, it's on my website. If you're interested in the details that go into the summary measure, we actually have many measures based on various subcomponents. So you might think that religious distance, for example, or distance in religious values is different from distance in values about economic policy or trust in neighbors and things like that. So we have it all disaggregated there. I apologize, I haven't really looked at it, just before this, because we use our baseline measure of cultural distance, which takes all the values that the survey asks about and averages them, and then looks at the average distance between each pair of countries. So I haven't looked at it in a while, but it's on my website and it's read.
Yeah, actually, it may be interesting if it's available for the public. If you have a RA or something, you can send it to us, and I'd like to kind of look at it myself, actually.
Oh yeah, the data is also on my website, so that is very easy, and the paper is published, so it's it's on my website also.
Okay, sure.
I put all my published papers there. Yeah.
Right. Okay. So Ashima, you want to ask your question?
Okay, sure. Hi. Hello, very interesting presentation. So I was wondering, this cultural barrier, I think you're talking about Indian diversity, but India also has a very large diaspora in the US.
Yeah.
And, you know, democracy and language, the English. So is that taken account of in the cultural variables?
So I haven't looked at that, but I have a colleague at the Paris School of Economics who has written a paper about this, showing that countries that have large migrant flows tend to have closer cultures. A part of the reason is the migrants bring with them some of the values of their origin country, but by far the most important factor is the migrants send back to their origin country the values of the destination country. So there's cross-pollination, but the second channel in this paper by Rappaport that is about cultural convergence through migration suggests that the main channel is diaspora send back the values of the country of destination, which is quite interesting. It's not my work, but it's germane to your question. Yeah, I would expect countries with more
Because the
migratory.
other thing I was in the current context, because of global value chains and possible diversification of value chains, so they would cut across some of these barriers, isn't it? But in a way, we know that a lot of this is concentrated in East Asia, very similar culturally. But you know, if industry is really interested in diversifying, then perhaps things like language and you know, political, in the sense that democracy is more stable than certain other kind of governments. So would that make a difference?
Yeah, so I mean, in this, so these are great questions. They're a bit far afield from this particular paper because we don't explore the sources of the cultural distance, except in the instrumental variables part where we use linguistic distance and you know what we call ancestral distance. You know, also how long have the you know countries been how long has it been since the common ancestor, you know, along the migratory paths from East Africa, things like that. So those things correlate strongly with cultural distance. You know, but I don't have a full account of what determines cultural distance between countries, and I suspect that a lot will be left unexplained if you try to do that. You know, you'd have a big residual. But
okay, Suman, you want to ask your question next, Suman?
Yeah, thanks. Can I be heard?
Thank you.
Yeah. Rohit, there's a lot to, just two quick reactions. One, you know the work of Chung Tai and Peter Clenau, you know, talking about, and even Abhijit, talking about, as it were, the big dispersion in returns to capital within developing countries. So I was just wondering whether, you know, this and your global analysis sheds any light on the barriers within countries, which ought to be lower hanging fruit than what you're aiming for. My second observation, I don't know, I mean, somehow, certainly where portfolio investment is concerned, my mental model had really been of target stocks and then flows as stock adjustments, whereas what I understood you to be really talking about was a model about flows. So is there any sense of adjusting to target stocks, or is that not part of the conceptual model? And my third point really would be about, as it were, monetary flows. I mean, the large buildup of international reserves with, you know, as a form of self-protection is, you know, that's a stock variable typically, but is it quantitatively enough to, as it were, contaminate your results? Thanks.
So thank you. There's a lot there. So you know, your first point is on misallocation. Yeah, I mean, our paper connects directly to the misallocation literature, but it does so in an international context where each country is considered to be, you know, a point in space. So we don't examine what happens within countries. So there's as you suggest, a large literature about misallocation within countries that exist. And I mean, it's just a different level of implementation. We implement it at the world level. These papers tend to implement it at more of a within country level, or looking at a specific country like India or China. Your second point was about the stock versus flows. So everything in our paper is stocks. So the model predicts stock of ownership of foreign assets in each origin country, in each destination, of each origin in each destination. So the way, of course, the stocks, when you remove the barriers in the counterfactual analysis, the way the stocks adjust is you get these massive flows. So your view of how big the flows are depends on what your view of the counterfactual exercise is. If you remove these barriers all at once, you get these massive one-time flows and an immediate adjustment of the stocks, which is probably not a realistic, way to think about things. It's also probably not a realistic way to think about things, to remove the barriers entirely altogether. So we are trying to bound the effects. We give you bounds on what would happen in the extreme case, and adjust accordingly depending on what you think is realistic. Okay, but so that's perhaps why you see such big effects, right? Because we get this immediate adjustment in the stocks. So that's I think the answer to your second question. And your third, remind me, Suman, sorry.
International reserves and, in a sense, capital flowing in the wrong way.
Yeah, I guess I don't know. I guess the honest answer is I don't know. And I would have to look at how those are treated in the underlying data that we use. My guess is that they're not included. They would not count as investment. You can think about China's ownership of US treasuries as, that they hold on the balance sheet of their central bank as being investment, I suppose.
Yeah.
But the honest answer is that I don't know. I would have to look into it.
Okay, thanks.
Last question. Professor Swami, do you want to ask?
Thank you, sir. I will also ask one small point. Professor
Yeah,
Romain,
go ahead.
Professor Romain, it was an excellent presentation. Many thanks to you. And it was very insightful. Actually, we also did a paper of a similar nature, and we wanted to find out the drivers of capital flows into the BRICS countries. So in that context, when we were thinking about the model, we decided on these important variables apart from others. That is the market size, ease of doing business, infrastructure index, sovereign credit rating, and the economic freedom index.
Yeah.
When I looked at the first, look at your presentation, the variables that your model captures seem to be generic, but as we are going deeper into the analysis of the flows, the capital flows, whether it's the foreign direct investment flows or the foreign private investment flows, I feel that the sovereign credit rating, as well as the market size, and also the infrastructure index, they play a very important role. What are your comments about this?
So I completely agree. They play an important role in our empirical implementation. We have a country of origin and country of destination fixed effects. So whatever, for example, whatever is time invariant or the time invariant component of the various factors you mentioned is captured in there, and it's a black box. It does play a role in the counterfactual analysis. We don't change them, but they do play a role in feeding into GDP these fixed effects. But they don't play a role in the sense that we can't pinpoint what goes into these country level fixed effects. A weakness of our approach is that to the extent these things are time varying, we don't capture that in our model. So if you think, for example, I know that India's ease of doing business ranking has been improving over the years, and that improvement, would imply a time varying fixed effect, which we don't have in our in our implementation. The main focus is really on bilateral variables that represent barriers, not on things that countries can do individually, to improve their capital stock. So it's obvious, for example, that if you build more infrastructure, you'll increase the return to capital, but that is a country level policy variable as opposed to a bilateral variable where you're trying to dismantle a barrier that is specific to a pair. So that's the distinction we have, and we only deal with the latter. Our paper does not really explore the former, except insofar as it controls for fixed effects, and therefore sort of washes away the variation that comes from them. But I'm very sympathetic to your approach, which is another approach to trying to understand the drivers of flows, which is completely legitimate, and I completely agree that one should ideally not control for fixed effects, but try to capture what the fixed effects are meant to convey, you know, and that's, I think, your approach looking at this this set of variables. I hope this is helpful.
Okay, thank you. I think we are spot on. We had 1 hour. Charan, should we conclude? Because, yeah. Charan?
Yeah,
Thank you very much.
To conclude, Professor Romain has to start his day. We are
Yeah.
on weekend, Friday, so we could spend time, but I'm sure he has so many other obligations for the day lined up. So if you permit me, I would like to simply conclude by saying that I want to thank all of you, the participants on a Friday evening at 9 p.m. joining us. And most importantly, I want to thank Professor Romain for having agreed to deliver this talk on a hotly prepared and just getting finalized paper. I want to thank him for the same. I'm sure the inputs here are going to be helpful for him in firming up the paper. I also want to thank Dr. Virmani to chair this session. Now, I have an important announcement to make. The presentation will be live on our website tomorrow by noon, and you're welcome to use it in your classes or wherever you wish. And we are going to, of course, use it for policy purpose. I have another good announcement to make. We are going to have Professor Kondapalli, who will be speaking to us next Friday at 5:30 p.m. He's a professor at JNU, and he's going to be speaking about China's increasing assertiveness. I think a topic which all of us have been waiting to listen in depth. Of course, there's de-escalation right now today, maybe because we are going to have this topic for 2 days. The de-escalation on the China-India border, both of them have moved their tanks and jeeps and people backwards. That's okay. But let's have this talk next Friday, and I would welcome all of you. 30 to 6:30. Our chairman, Dr. Virmani, who's also an expert on geopolitics.
Yeah, I just want to add that though this is probably the first in our series of national security, so that's one of the topics in EGROW, not the main one, but we are going to have more of the national security related talks. So the first one will be on China, yeah. So
yes,
yeah, invited to tell your friends who are more interested in national security than on economics, they can join. Thank you.
And
Yeah.
we are planning the next one on my birth, which will happen in April. So with this, let me once again thank Professor Romain for having agreed to come and deliver the talk, and to all the participants and our chair. Good night.
Thank you both for inviting me. It was a pleasure to be here, and thank you for the great comments.
Thank you. Thank you.